Kuzuzambo, welcome to Bhutan e-learning program. I am Dawasring from Mutithang High Secondary School. This is accountancy lesson for key stage 5, that is for class 11 and 12. And the topic that I'll be presenting is on conceptual framework of accounting or accounting system. Now I have the objectives of the lesson. Lesson objectives: understand the conceptual framework of accounting, explain the elements of financial statement, describe the recognition criteria of each element, and the elements will be explained covering the following concepts, that is definition, recognition, measurement, presentation, and disclosure. Now the elements of financial statements. Following are the elements of financial statements, and they are assets, liabilities, equity, income, and expenses. Okay, the first we have is assets. And assets is a resources controlled by an entity as a result of past events and from which the future economic benefits are expected to flow to the entity. I have also given the examples, and based on the examples I have also categorized the types of assets or classification of assets: property, plant and equipment, inventory, patent, copyrights, and so on. So the first three, that is property, plant and equipment, they are categorized as non-current assets. The assets which the business have held to be used for a longer period of time, or usually these are considered as the long-term investment of the business. And the second one we have is inventory, and inventory is categorized as a current asset. Those assets which are usually held by the business for a shorter period of time, usually say for 1 year, or the assets which are held by the business for resale or to be used in the business, they are considered as a current asset. Anyway, I have a detail given for each of this. And the last we have is the patent, copyrights, goodwill, franchisee holders, and so on. So these are considered as the intangible assets, and intangible assets are those assets which we cannot see or touch, but we can feel the technical value of those assets. So these are the categories or the types of assets which I have mentioned here. Anyway, we are going to look at in detail down the line. Okay, now the next one we have is the essential characteristics of an assets, and they are: number one, we have already covered under the definition itself, yet I have listed down the essential characteristics of an assets. The first one we have is future economic benefits, which means the physical form is not a prerequisite. The second we have is controlled by the entity. The future economic benefit must be controlled by the entity. The future economic benefits which are not currently controlled by the entity are not assets. Inventories which are expected to be acquired by the entity next month, they are not considered to be the asset at the present. An asset does not have to be legally owned, which means the assets which we have taken on lease, they are also considered as assets, since as per the characteristics or as per the criteria they qualify to become the asset. The third one we have is existence as a result of past transactions or events. So just to explain further, I have again the example, that is accounts receivable. So accounts receivable, firstly, it qualifies to become an asset because by definition it is a future economic benefit. Yes, it is considered as a cash collection, therefore it qualifies to become an asset. Secondly, it is controlled by entity. It is controlled by entity. Yes, accounts receivable belongs to the entity. Last we have is existence as a result of past transactions or events. It is considered as the past sales transaction, therefore it qualifies to become an asset. And the second we have is recognition criteria. If cash receipt is probable and the amount can be measured reliably. Okay, as I have already mentioned, now let us look at the types of assets. The first we have is current assets. Current asset is an asset which satisfy any of the following criteria. It is expected to be realized in or is intended for sale or consumption in the entity's normal operating cycle. So, the example which we have already looked at is accounts receivable. It is primarily held for trading purposes, for example, inventories. These are not held by the business for a longer period of time, rather it is to be used for the purpose of resale. It is expected to be realized within 12 months after the reporting period, for example, rent advance. It is cash or cash equivalent, examples like cash, bank, treasury bills and so on. Okay, in line with the types of assets which we have looked at just a minute ago, since we came across a term known as operating cycle, I am also going to give you the meaning of operating cycle. The operating cycle of an entity is the time between the acquisition of assets for processing and their realization in cash and cash equivalent, and that is given much in detail, paragraph 68 of BAS, that is Bhutan accounting standard. If an entity's operating cycle is not clearly identifiable, it is assumed to be for 12 months, and the same in detail we have in the paragraph 68 of BAS. Now, the second kind of the broader asset we have is non-current assets. Non-current assets are all other assets which are not current assets are considered as non-current asset. So, therefore, I have also mentioned here all other assets are to be classified as non-current assets. So, which means the assets which do not qualify to become current assets, they are considered as non-current assets. Example, we have property, plant and equipment, and this may also include land, building, factory and so on. Investment property usually are land and building, and we have also the intangible assets, trademark, copyright, brands, franchisee and so on. So, these are considered as non-current asset, and I have also told you the meaning of intangible assets. And once again, just for your reminder, intangible assets are those assets which we cannot see or we cannot touch, but we can feel the technical value of those assets in order to enhance the earning capacity of a concern. So, that is all with regard to non-current assets. Now, the next elements of the financial statement we have is liabilities. A liability is a present obligation of the entity arising from past events and the settlement of which is expected to result in an outflow of economic benefits from the entity. And we have also the characteristics, the essential characteristics of liabilities, and they are: number one, we have a present obligation, and basically the obligations are of two kinds, and they are legal obligations and constructive obligation. First we have is legal obligation, arise from the legal contracts or are imposed by legally authorized body or government or the other operations of law. The second one we have is constructive obligations. The entity has indicated to other party that it will accept certain responsibilities, or it has certain valid expectation on a part of those parties that they can reasonably rely on it to discharge those responsibilities. So, these are the two present obligations. And number two, the settlement of obligation will result in an outflow of economic benefits in the future. And the third one we have is exist as a result of past transactions or events. Now, I have an activity for you all. So, you just go through the statement given here and you are required to answer the following two questions. I will just take you through the question. Firstly, I will just take you through the statement. ABC company has published an environmental policy to replant trees to counterbalance the environmental damage created by their operation. It has a consistent history of honoring this policy. During 2018, it opened a new factory leading to some environmental damage estimated at Newton 400,000 for restoration work. So just knowing the statement I have just here, now you are required to answer the following two questions. So number one, do ABC company have present obligation? And you have to justify your answer why. And number two, ABC company in the year 2018 decided to install new safety equipment in the factory in the year 2019. Do ABC company have present obligation and why? So you have to critically think about the statement here, and you have to answer it accordingly, and more importantly you have to provide justification for these two questions. With this, let us proceed further. Okay, now the next we are going to look at is the examples of liabilities. The examples of liabilities I have just got it here is accounts payable. And now let us look at how accounts payable qualifies to become a liability. Accounts payable qualifies to become a liability because there is a present obligation, and at the same time the settlement requires an outflow of economic benefits in the future. And the third one, it exists as a result of past transactions or events. So since the essential characteristics are all there in case of accounts payable to qualify it as a liability. So therefore accounts payable is one of the examples of liabilities. Now let us look at the types of liabilities. The first we have is current liabilities. Current liabilities is a liability which satisfies any of the following criteria. It is expected to be settled in an entity's normal operating cycle. Example like accounts payable, and with regard to accounting operating cycle, I have already just taken you through. Hope you are aware with accounting cycle. Next we have is it is held primarily for trading purposes. Next, it is due to be settled within 12 months after the reporting period. Example, rent unpaid. There is no unconditional rights of deferring settlement beyond 12 months after the reporting period. Example, the portion of a loan payable within the next accounting period. That is with regard to current liabilities. Now next we have is non-current liabilities. Liabilities that do not satisfy the preceding criteria are classified as non-current liabilities, and to have this in detail, it is reflected in paragraph 69 of IAS. Example, bank loans, provisions, long-term debts are considered to be the non-current liabilities. Now the third element of the financial statement we have is equity. Equity, as I told you in simple term, it is the difference between the assets and liabilities, and here also I have mentioned its definition. The residual interest in the assets of an entity after deducting its liabilities are considered as equity, and this cannot be defined independently. The main components of equity, they are contributions by shareholders, and they are also termed as a share capital. We have retained earning, we have reserves, and we have revaluation surpluses. Now the next we have is number 4, that is income. Okay, income is defined as an increase in economic benefits during the accounting period in the form of inflows or enhancements of assets or decrease of liabilities that results in increase in equity other than those relating to contributions from equity participants. They are considered as income. And for detail again we have in our conceptual framework paragraph that is 4.2 and subset A. The two essential characteristics of income are an increase in assets or reduction in liabilities. Next we have is an increase in equity other than as a result of contributions from the owners. Income encompasses revenue and gains. Revenue is a gross inflow coming from the entity's ordinary activities, while gains are income arising from the activities which are not ordinary. So this even shows the differences between the revenue and gains, though they can be vaguely differentiated, but they can be slightly differentiated as I have just mentioned here. And the last we have is the expenses. First, let us look at the definition. Expenses decreases economic benefits during the accounting period in the form of outflows or depletion of assets or increases of liabilities that results in decrease in equity. Now the recognition of expenses. Expenses are recognized when expenses is incurred and items can be measured reliably. An example of expense is wages, which involves outflow of cash and cash equivalent to employees for the provisions of services. Depreciation is example of an expenses involving the depletion of assets. Okay, in line with the elements of the financial statements, I have also included how to recognize the profit. That is what we say it as a profit recognition. When and how much? The profit recognition principle provides guidance on the timing and the amount of profit to record, or more precisely, revenue and expenses recognition. Profits, we also call it as revenue, should be recorded when earned and not before. Interest and rent accrued with the passage of time. More sales and much services revenue is recognized at a point in time. Recognition criteria for all elements. So I have also mentioned the general recognition criteria for all the elements. And they are: number one, it is probable that the future economic benefits associated with item will flow to or from the entity. That is a probability test, a subjective test requiring judgment by the preparer. More than a 50% chance of occurring. Number two, the item has a cost and other value that can be measured with reliability, a reliable measurement test. A reliable measure is one which represents faithfully the economic reality. So that's regarding the overall recognition criteria for all elements, and the next point we are going to look at is the measurement issues. Measurement involves the process of determining the monetary amount at which the elements are to be recognized. The major measurement methods: number one, we have is historical cost; number two, current cost; number three, realizable value, and we have also the present value. So the first we have is historical cost. The actual cost, the actual purchase cost, what was paid for the assets or expenses, is considered as historical cost. And for this, I'll just provide you with the simple idea. Current cost, replacement cost. It is considered as a replacement cost. Realizable value, the amount of cash and cash equivalent that could be obtained currently by selling the assets in an ordinary disposal or in the normal course of business. And next we have is present value, the value of an item to be received or paid for in the future expressed in terms of its value today. Okay, now the next point I'm going to present is on the qualitative characteristics of financial statements. Okay, which means what makes accounting information useful. Okay, and they are: number one, we have is understandability, we have relevance and materiality, reliability, compatibility, constants on relevancy and reliability, timeliness, cost versus benefits. So these are the qualitative characteristics of financial statements. So again, for those also, I have summarized the points and I have just mentioned below. So let us look at this now. Okay, the first we have is materiality. The information is material if its omission or misstatement could influence the economic decision made by the users of financial statement. Next we have is depend on size or on the nature of item. Some issues are materials regardless of the dollar's value and must be disclosed, example director's salaries. Next we have is reliability, concerned with accuracy, validity and verifiability. Under that we have is the faithful representation, which means the financial information should be faithfully represented transactions that have occurred. Next we have is substance ever form, economic reality not a legal form, example lease. Neutrality, free from bias, it should be free from bias. We have prudence, cautious in making estimates. We have the last, that is completeness, which means there should not be omission, there is no omission. Okay, next we have is comparability. Comparability information. Users are able to discern and evaluate similarities in and differences between the nature and effect of transactions and events at one time and over time within or between entities. Allows evaluation of similarities and differences, that is spatial, that is across the business, and temporal over time. Leads to standardization, which means in terms of terms, format and procedures, and consistency. Consistency adds compatibility. Now next we have is the constants on relevant and reliable information, that is timeliness. Report without undue delay. So if it delays, then the relevancy is going to go down, and if it is haste, again it is going to lead to inaccuracy and reliability is questionable. And the next we have is cost versus benefits, weighing the expenses of providing information and the benefits derived from that information is a matter of professional judgment. Okay, with this I have an activity for you again. Identify the different categories of assets from your place and find out how it can be recognized in the financial statement. That's number one. Then number two, access on financial report of a company and see how revenue is recognized. So with this we come to the end of this lesson, and see you in the next lesson.